How U.S. tariffs are reshaping global trade and profits. Welcome to WorldFlow Finance. Today, we dive into one of the most seismic shifts in global commerce, the sweeping U.S. tariff strategy that's shaking trade flows, supply chains, consumer prices, and corporate profits worldwide. We'll break down the latest data, humanize the ripple effects, and explore what lies ahead, for businesses, consumers, and nations alike. U.S. tariffs, what's really changing? In May 2025, U.S. goods exports dropped by 5.2%, a $9.7 billion plunge, marking the steepest fall since the 2020 pandemic. A significant slowdown followed a new 10% universal tariff and heavier levies on industrial metals and vehicles. Simultaneously, 145% tariffs on Chinese goods slashed container volumes by 25% at West Coast ports, and dockworkers and retailers suffered. This isn't just trade numbers. It's lost jobs, idle containers, and picked over shelves. Global economic ripples. Trade volumes and shifting routes. According to OECD and UN, global GDP growth forecasts for 2025 have been downgraded, from 3.3% to roughly 2.9%, due largely to tariff-driven disruptions. UNCTAD confirms global trade growth slowed in Q4 2024, with trade tensions disrupting what was a $33 trillion ecosystem. Boston Consulting Group projects U.S. import costs could rise by $640 billion, with China, Mexico, Canada, and others hit hardest. But they warn that trade routes are reorienting fast. U.S. becomes less central while global South economies build new connections. Sector-by-sector impact. Automotive. 25% tariffs on cars and parts have increased production costs by $2,000 to $12,000 per vehicle. Stocks of global automakers slid. U.S. consumers face price hikes of $5,000 to $10,000 per vehicle. Metals and construction. Steel and aluminum tariffs at 25 to 50% rerouted Chinese exports to Southeast Asia, plunging regional steel prices by 12%, while U.S. construction costs surged. Consumer electronics. A baseline 10% tariff on Chinese electronics, escalating to much higher rates, has spiked U.S. smartphone and laptop prices by 12 to 15%. South Korea and Japan are benefiting, with their electronics exports growing into U.S. markets. Pharmaceuticals and medtech. Tariffs of up to 125% on Chinese APIs disrupted supply chains. India has partially stepped in, but capacity constraints remain. European companies hit by 20% tariffs are considering relocating production. Agriculture and textiles. African nations like Lesotho and Madagascar may lose thousands of textile jobs as AGOA preferences dissolve. Tariffs threaten cocoa and vanilla exports from Madagascar, Ghana, and Côte d'Ivoire, putting economies and farmers at risk. Economic fallout and human cost. Deloitte reports that consumer confidence is plunging. Michigan's index is near historic lows, sparked by fears over tariffs, inflation, and job security. Household costs have surged. American families are paying $1,300 to $1,900 more annually, according to Reddit discussions on U.S. Canada tariffs. Strategic responses. United States-U.S. policy and retaliation. Congress is probing a trade deal framework with China after a 90-day tariff pause, but threats of 50% tariffs on EU goods persist. The EU is bracing with stepped-up counter-tariffs up to €95 billion, especially targeting autos, steel, and aluminum. Allies and trade realignments. Europe accelerates pacts with South America, Switzerland, and Mexico, building a parallel trade bloc. China deepens ties with the Global South, projecting $1.25 trillion in new trade over the next decade. Friendly nearshoring shifts manufacturing from China to India, Vietnam, Mexico. Apple's iPhones from India are projected to hit 25 to 30% of global shipments in 2025. Corporate profit impacts. U.S. multinationals, once globalization's beneficiaries, are feeling squeezed. Profit margins shrink as input costs rise. Some sectors are adapting with friendshoring, others pass costs to consumers, like Nike's $1 billion tariff hit. Certain domestic industries, steel, localized manufacturing, see gains, but overall, economists say tariffs reduce national welfare and curtail productivity. What comes next? The suspension deadline for reciprocal tariffs is July 9, 2025. Without a deal, expect heightened volatility, markets may react, and the Federal Reserve may reconsider interest rates. Countries are reimagining trade alliances, look for new agreements involving the EU, CPTPP, BRICS, Africa, and Latin America. Companies and nations are marching toward economic decoupling, reshoring, friendshoring, diversified supply chains, reshaping the future of global commerce. U.S. tariffs aren't just taxes, they're tectonic forces that shake global trade maps, reshape supply chains, and alter consumer lives. While some industries may profit short-term, the broader economic consensus is clear: welfare declines, uncertainty rises, and trust erodes. But one silver lining exists: businesses and nations are learning to pivot, finding resilience through diversification and new trade relationships. As we approach the July 9th deadline, buckle up. The next few months could define global trade for years to come. Thanks for tuning into WorldFlow Finance. If you found this analysis valuable, hit that like button and subscribe. Got questions or want a deep dive into a particular country or sector? Drop a comment below, I read every single one. See you in the next video.